Try to answer any and all questions that they see pop up. Real quick, NFP is just under a $2 billion in revenue company. Really, we focus on the employee benefits and the property and casualty. And obviously today we'll be focusing more on the transactional side of things and really on the SPAC world. And our focus has been to really bring in the best and brightest talent. And that's why you have John and Andrew on the line today. Andrew actually leads our SPAC practice for NFP, came over from Marsh, and he'll give a more in-depth intro. And as we all know, with SPACs growing in popularity, we wanted to put together this webinar just to try and really touch on something that everybody wanted to learn more about. And I'll pass it off to you, Andrew, if you can give a brief introduction, and then you can jump into things.
Excellent. Yeah, thank you, Adam, and I appreciate everybody's time this morning. As Adam mentioned, I lead the SPAC practice here at NFP. We advise SPACs throughout their entire life cycle. And a lot of what I do, as you can imagine, is educating clients and their third-party advisors on the risks and liabilities that they face. And that's what we'll do today. And so to Adam's point, we'd like to keep this as interactive as possible. I think everybody here will assume has somewhat of a base understanding of maybe what a SPAC is, but doesn't understand the liabilities and exposures that they might face, and what the tools and products from an insurance perspective are that you can use to mitigate some of the impact of those liabilities. And so what John and I will talk about today is the securities class action landscape for SPAC, specifically recent trends. What is a D&O insurance policy, and how does that get structured in the context of a SPAC? That market, as you may have heard, some of you that may be advising SPACs or thinking about doing a SPAC, is hardened significantly over the past 12 months. Then we'll also talk about transactional risk products, and that's John McNally's expertise, is the reps and warranties. And so, John, I'll pass it over to you to maybe give a brief introduction.
Yeah, thanks, Andrew, and really great to see everybody on the call, on the meeting. I lead NFP's merger and acquisition risk solutions practice. So besides our SPAC and general partnership liability practice, we have a team, we'll talk about this towards the end, that focuses on insurance diligence and operational insurance for newly acquired businesses or merged businesses. We have a team that focuses on rep and warranty and tax and litigation insurance, so insuring deals or aspects of deals themselves. We have a team that focuses on distressed transactions as well. So as Andrew mentioned, for SPACs, we're sort of cradle to grave in terms of de-risking and insuring them, but across the private equity and M&A, we have solutions for everything from distressed deals to healthy deals. But again, today's focus, and Andrew is one of the leading, if not the leading broker in the market for SPAC D&O insurance. So we'll bring it back there, and that's what we want to really try to educate you on today.
Thanks, John. So again, we have a few slides here. This is not going to take a full hour to go through. So if you have questions, please bring them up as we go through this. So I'll go ahead and share my screen so everybody can see the presentation today. Nicole, is that coming up okay? Perfect. Excellent. Okay. So as far as, and again, right, some of you on the phone may be thinking of launching a SPAC, but others are most likely advising them, right? And so what are the services that a SPAC utilizes from an insurance perspective, start to finish, okay? The majority of what we'll talk about today, and what is most important for SPACs team up front, is D&O insurance, right? To cover them through their due diligence period, right? This is intended to protect both the individuals and the SPAC itself, right? From securities claims brought by third parties, prospective target companies that they may or may not transact with, from a defense and a settlement standpoint, right? So it's protecting effectively the personal assets of the D's and O's. But beyond that, right, a SPAC's life cycle is pretty broad, and the services that they need to be provided with are as well. And so insurance brokers will also provide due diligence services, right? So red flags and gap analysis on the target as they're identifying and signing letters of intent. Transactional risk, as John McNally mentioned, is becoming a much more prevalent line item for SPACs. Historically, reps and warranties insurance had been a product that was used pretty much on private equity deals only, right? And some public company M&A. It has now come into the SPAC context and is being utilized more frequently on more deals to help protect SPAC sponsors against the reps that are being made on behalf of sellers. And then lastly, advising SPACs through the de-SPAC process. It's pretty unique, right? It's not an IPO. It is a merger, but there's certain representations being made, by both parties. And so walling off exposures on both the target side and the SPAC side and placing new D&O insurance and combined insurance on a go-forward basis is something that takes a good amount of work and a good amount of time to prepare for. And so from start to finish, that's everything that if you're looking at forming a SPAC or advising a SPAC, they should be considering from an advisory services perspective when it gets down to insurance. So again, largely educational today, right? And this is what we'll walk through with our clients who are considering SPACs. When we talk about their exposures, right? So where could you potentially see liability from if you are a SPAC sponsor? And what we've done is we've broken it out here, basically the 4 life cycles, right? The 4 points in time during a SPAC, right? From S1 filing to the due diligence phase, to the proxy filing, to the initial business combination, right? And where could we see true claims emanate out of? So we'll begin with the S1 filing. For a traditional public company, this filing is what drives the overwhelming frequency and severity of securities class action litigation. The reason being is that you file your S1, you go public, and there's immediate volatility, right, within the stock price. That, for the most part, is what D&O insurers are concerned with. In that first 3-year period post-IPO, you can see a whole host of litigation, right? SPACs are unique in that there is really no volatility after the IPO. The funds are raised, and all of those assets, with the exception of a nominal amount of working capital, are put into a trust account. Okay? That can't be touched to do anything other than to fund a transaction. So you can't even use it to indemnify D's and O's. Because of that, and because of the broad nature and relatively unspecific nature of SPAC S1s, we don't really see any litigation or any securities claims point back to the S1 as the basis for that claim, that being false or fraudulent or misleading. So rarely, if ever, does this get pointed to as the reason for a securities class action claim. Now, as we go through the due diligence phase, again, we haven't incurred any investor loss because the deal hasn't been consummated yet, right? So where can we see liability from? Mainly, that would be from prospective targets that you may or may not transact with as a SPAC. And so we have an example in this deck of G2Y Technologies and OpenGov. G2Y Technology was a SPAC focused on software as a service. They looked to transact with 6 back office software as a service companies for local and state governments as their business combination, which is, again, is already unique. Most SPACs will look to merge with a single target. In OpenGov space, they had plans to roll 6 up into a single merger. They ended up leaving the 6th out, which was OpenGov. And OpenGov brought a suit against them alleging breach of confidentiality, breach of contract, and theft of trade secrets. All in between defense and settlement, that claim ended up being about an $8 million claim. Where your liability as a SPAC really ramps up, as you can imagine, is when you file your proxy. Okay? That is the single most important document when it comes to a SPAC's life cycle. And so what the proxy filing effectively is it's a second prospectus. Okay? It's not in the form of an S1, it's an S4, generally speaking. And it will give you all the details on the transaction itself, how it's being funded, how it's being structured. It will give you details on the current financials of the company. And what's unique to the S4 is it can also provide guidance on future growth. Okay? That, from a securities claims perspective, is somewhat concerning, right? Whenever you're providing guidance, you're giving security holders the opportunity to bring suit that you may have misled them, right? And so there are 2 types of litigation that can emanate out of a proxy filing. One is more of a nuisance style claim. The other is more severe. And these are the 2 most common types of litigation that we see when we're talking about what do the trends look like in the securities class action environment for SPACs. We'll talk about the first being the nuisance style claim. Okay? And this, again, this is being filed or threatened to be filed on just about every proxy that comes out. It comes in after the proxy is filed, prior to the deal being consummated. Effectively, you'll file your proxy pitching the deal to shareholders. A plaintiff's firm will travel around trying to form a class and will bring a securities claim that will allege a few things. One, it will probably point to the proxy and state that there are inadequate disclosures made within that proxy file. Generally speaking, related to how the financial analysis was done or how it was presented. It may even point to how certain third parties are being compensated and the lack of details. Effectively, it'll state that shareholders do not have enough information to make an informed decision on whether to vote yes or vote no within the transaction. In addition to that, it may actually even allege that the SPAC sponsors breached their fiduciary duty to shareholders. The promote structure within these deals inherently dilutes shareholders after the business combination has been completed. Effectively awards the founders 20% of the economics that the SPAC is bringing to the table after a deal is completed, and so shareholders are diluted. That's all laid out crystal clear in S1s. And so the majority of these claims will come in and either be voluntarily dismissed, or they will go away by paying a nominal fee to the plaintiff's firm. It's very similar to the bump up style claims that we see in public company owners. Where we see significant and more severe litigation, again, because that nuisance claim occurs prior to the transaction, again, there's no investor loss. Where we see more significant litigation actually doesn't come in until after the de-SPAC has occurred. And so what will happen is the proxy will be filed, there will be a vote, the shareholders will vote yes on the deal in some capacity, there may be a pipe raised alongside it to provide additional financing, the deal closes, and then let's say in the case of Nikola or XL Fleet more recently, a short seller report comes out sometime after. Maybe that's 6 months or a year or 2 years later, right? The statute of limitations on fraud claims when it comes to securities is 6 years, so it could technically be at any time in that 6-year window after the deal closes. And what it'll say is it'll call some part of the business into question, right? And it will point to the proxy filing, and it may point to the press releases that were issued by both the SPAC and the combined company leading up to the transaction, okay? That short seller report will result in a stock drop of some magnitude, 10, 20, 30, 40%, right? And in the case of Nikola, it was pretty severe. Because of that stock drop, you will then see a follow-on securities class action. The securities class action will name the combined company as defendants. It will also name the combined company's CEO and CFO generally, but it will also name potentially the former CEO, CFO, and other board members of the SPAC. It will point to the proxy filing and the press releases as being false or fraudulent or misleading, which the SPAC directors and officers are ultimately responsible for. Now that we have tangible investor loss and a stock drop, those types of claims could be quite severe, okay? From not only a settlement perspective, but also from a defense cost perspective. The median settlement value for securities class action claims last year, and again, this is not just SPACs, but was about $13 million. The average was closer to $40 million. That does not even include defense costs, right? And at today's rates, those could add up pretty quickly for SPAC directors and officers. And so that is generally speaking the most significant issue facing SPACs right now. On a post-close basis, you're subject to the same scrutiny you would be for Ks and Qs and press releases that you release on a post-close basis, but that is the liability effectively of the combined company and their exposures. So I'm going to pause there. I think I saw some questions come in the chat. So let me just open that up. Bear with me here. Okay. Have you seen any particular risks or opportunities related to using a reverse merger structure to go public? This is coming in from Jim Fornoff. Thanks for the question, first of all. I think the risks to the SPAC are what we've just described, right? In that you could see securities litigation based on the representations you are making. I think what is missed sometimes is the fact that the target company is effectively subject to the same issues. Yeah. The target company, by going through a reverse merger as opposed to going through an IPO, is not skirting any sort of securities litigation, right? They're still taking representations, providing them to the SPAC, who is then making those representations in a public filing. And so you're effectively opening yourselves up to the same sort of litigation from a securities perspective that the SPAC is, right? You're ultimately responsible at the end of the day for that representation that's being made to the public, even though it's the SPAC shareholders and maybe not your own shareholders because you're not selling shares through an S1. So I think that portion of it is sometimes missed by the target companies, that they are opening themselves up to relatively similar securities exposures that the SPAC is and that you would see through a traditional IPO. John, do you have a question? Did you want back there?
No, I think it's a great question, and we'll talk a little bit more at the end about insuring, those seller reps and warranties using rep and warranty insurance, and why that's going to be really helpful above and beyond any recovery that may or may not happen. I mean, private company D&O insurance policies, which is what the target company most likely has. And Andrew may touch on this, they don't really pick up a lot of the securities claims the way that a really strong public company D&O policy would, the kinds of policies we put in place for the SPAC entity. So the de-SPAC transaction does present a number of additional risks. I mean, are they the same risks you'd have on an IPO? Yes, but there's some other ones as well. As Andrew mentions beyond that, because now you've got two different entities that are faced with potential securities issues and not just one.
That's exactly right. So in the context of different types of D&O insurance policies, to John's point, a target company being a private company will be on what's known as a private company D&O policy. The one caveat to a D&O policy, a private D&O policy, is that they're specifically intended to not cover securities litigation as it relates to an IPO, most likely, but some are worded pretty broadly where they're intending to eliminate any sort of securities claims. And so you have to be careful when you're going through a transaction with a SPAC that your policy doesn't exclude kind of your biggest exposure as you're going through that transaction. So that's a really good point, John. Any other questions on the securities class action litigation environment or claims that we've seen, any sort of examples? Happy to answer those questions. The remainder of the presentation will focus on the products, D&O insurance, and reps and warranties and how those are used. So feel free to chime in now. Give everybody maybe 10, 20 seconds to type in. Okay. All right, well, we will move on then. So you have all these exposures, right? What do you do about it? How do you protect yourself? Is there a way to make sure that I don't lose my house if I get sued as a director and officer? And the answer is yes, you do. It's called Directors and Officers Liability Insurance. And so here is a general overview of what a D&O insurance program is intended to cover, right? And the different options that you have within D&O insurance broadly, okay? So this is a traditional structure for a SPAC D&O program. These three blue boxes here make up what we call a full cover D&O contract, okay? Full cover D&O is a blend of what is known as Side A, Side B, and Side C, okay? So to walk through those independently, Side A is also known as non-indemnified loss or personal asset protection. This is the most important coverage for public company directors and officers, but specifically for SPAC directors and officers, and I'll explain what it is. Effectively, if you're sued as a director and officer of the SPAC and indemnification is not available to you, okay, the policy will respond immediately after indemnification has been exhausted from $1 at that point. The reason that is important is that it stops you from having to go out of your own pocket, right, to pay for defense and settlement on your behalf. Why is this so important in the context of SPACs? Well, if you think of how a SPAC is structured, right, and we talked about this briefly before, but the funds that are raised via the IPO are all held in trust. There's a nominal amount of working capital at the outset of the IPO that is almost entirely used up to pay for third parties, to pay for insurance, to pay for other things. Whereas at the end of the day, when you're doing diligence, you're going to have a nominal amount of working capital, a couple $100,000, which in the context of a securities claim is going to go very quickly if you're paying defense costs on behalf of 5 to 7 directors and officers, okay? So the Side A could very well come into play very quickly for a SPAC, as opposed to a traditional public company who maybe has a full balance sheet full of cash and assets to indemnify directors and officers. So during the due diligence period, the D&O policy put in place, the Side A portion of coverage is what really is going to respond and what's going to be most important. Side B and Side C are what is known as balance sheet protection, okay? These protect the balance sheet of the company as it indemnifies either the directors and officers or in Side C's context, the entity itself in the event that it's named in the securities class action claim. Both of these coverages are subject to a policy deductible. Side A does not have a deductible. It simply kicks in once indemnification is gone. Side B and Side C come into play after the deductible has been satisfied. So that basically the balance sheet of the company has to indemnify the directors and officers in the entity up to a certain amount, then you have coverage. That is a full cover D&O contract. Every SPAC or most SPACs traditionally have bought some level of full cover D&O. They will then top that up to get to whatever they feel is a sufficient limit with additional Side A, additional personal asset protection. Okay. So from a conceptual basis, what does a SPAC specific program really look like? And this is it. Okay. We'll walk you through this step by step. Effectively, SPACs will always buy a 24-month policy period. Traditional public companies will buy 12-month annual policy periods that they will renew. Given the nature of a SPAC is to get a business combination done within 24 months, we line the insurance policy up with that. Okay. We have here represented a $10 million program. That's probably pretty in line with what the median purchase is for a SPAC in today's context. Okay. If I had shown you benchmarking maybe a year ago or 13 months ago, SPACs are buying closer to 20 to 25 million. Given where the market has gone, and we'll talk about this in a second, for directors and officers insurance, it's gone incredibly more expensive. And so SPACs are buying less and less because their dollar is going not as far effectively. So this is a pretty good representation of what a SPAC will buy. Give it, a SPAC between 200 million to 400 million, right? We'll buy somewhere between 10 to 15 million total wins. They'll buy 5 million of full cover D&O with additional 5 million of Side A. That deductible that you'll likely see for the balance sheet portion of coverage will be somewhere between 3.5 to 5 million per claim. To give you some context of the marketplace, because if you're advising SPACs or if you're thinking about SPAC, you've probably heard about how difficult the D&O marketplace has been recently. And so why is that? There's a few reasons. One, we've seen increased claims frequency and claim severity, right? So obviously those nuisance claims are coming in on every proxy filing. That's not necessarily concerning the insurers. What's concerning them is the number of post-close securities class action claims we have where there's tangible investor loss. So you have Nikola, you have Akazu, you have QuantumScape, Triteris, right? You have a number of these claims out there. The other half of that is that the marketplace for SPACs, as far as who provides the insurance, is very limited. There are 5 to 6 carriers that will provide D&O insurance for SPACs on a consistent basis, okay? In comparison to the overall public company marketplace of maybe 40 or 50 companies. So given where demand has gone, right? We've had over 500 SPACs complete IPOs over just the past 15 months, and where the supply is, which is incredibly limited, we've seen a significant tightening of the marketplace, okay? New insurers, you'd think, right, given where prices have gone, to give you a sense, a program like this in today's market will cost you somewhere around $1.1 to $1.2 million upfront for the 24-month policy period. We have certain products and strategies that we can discuss offline that reduce these upfront costs by about 20. We have strategies and specific products for SPACs that can reduce these costs by 20 to 40% by getting a little more creative. But you want to go and buy the traditional approach, which may not make all that much sense anymore. It's about 1.1 to 1.2 million, right? So you think, why aren't insurers jumping at this opportunity? It seems so expensive. There's a lot of premium in it. Their concern is that they know that the claims aren't going to come in until companies start de-SPACing, right? And then even then, after the de-SPAC occurs, you're likely not to see the claims activity until 6 to 12, possibly longer, after the de-SPAC has occurred. Start to finish, D&O claims that come in take about 2 to 4 years to resolution. And so they don't have the data yet. And they're worried that we have, call it 500 SPACs out there with over 150 billion in capital deployed. What happens when all of them start transacting? What does that look like from a securities class action perspective? How many claims are we going to see? How severe could those claims be? And so a lot of insurers are taking a wait and see approach to it right now. Okay, another question come in from the SPAC. So does a company John, thank you for the question. Jonathan Wallace asks, does a company that is being purchased by a SPAC target prior to the acquisition by the SPAC have the same litigation risk as the SPAC acquisition board and shareholders? Interesting question. Presumably, yes. I mean, it's going to depend, right? So if you were going through, let's say you're going through a SPAC merger, or excuse me, if you're going through a merger between two private companies and then that merged company is then going through a SPAC transaction. If you're the CEO of the company that's merging, right, and both of you stay on the go-forward board, you are then both making representations to the SPAC as a combined company. So yes, in a sense, you would then be responsible for those representations that are being made to the SPAC because you've combined prior to. Effectively, in my opinion, at least, I think that liability carries forward as long as you're the one that's ultimately making those representations to the SPAC.
I think that's right, Andrew. And the timing, I think, is really important as well. So if you had, prior to the SPAC, the de-SPAC merger transaction, if this business was acquired by the business that the SPAC is acquiring, right? So the target company does, an acquisition, and then some period of time later does the SPAC. Obviously the representations and warranties that were given in that pre-de-SPAC transaction are still going to be alive, and you're going to have liability there. As Andrew said, if it's a simultaneous transaction, you may have securities liability as well. If it's a predecessor transaction, then I think you probably remove yourself from some of the securities, litigation risk. You're not going to have knowledge necessarily of the SPAC transaction, and knowledge and scienter is a really important aspect of liability on securities claims. So I think the timing probably goes to it. I agree with Andrew. If it's a simultaneous kind of transaction, you're probably stuck with a lot of the same liability. If it's a predecessor transaction, if I understand the question right, you probably avoid some of that securities litigation, but not the liability for the reps and warranties.
Yeah. That was a great question. Thank you. Rounding out the conversation, unless anybody else has any other follow-on questions to that, rounding out the conversation on D&O insurance and the market for SPACs, right? It's expensive. What are the key factors that the underwriters are looking at, right, when they underwrite SPACs? It's four things, right? When we think about underwriting metrics, it's the size of the IPO. They're somewhat agnostic to that, as long as it's within called the median range, right? Median range being somewhere between 250 to 400 million, okay? You go a little bit below that, you go a little bit above that. It really doesn't change the math that much. When you get excess of call it 500 million, right? When we get into the $700 billion SPAC offerings, those are treated a little bit differently because now you're hunting in a different realm, right? SPACs will traditionally end up with 20 to 30% of the economics of the post-close company. So if you have $1 billion, you could theoretically be transacting with a $4 billion company or more, depending on the size of the pipe you raise, right? So that changes the game a little bit for the underwriters. What's most important is the experience of the management team. They want to see a management team that has extensive experience performing due diligence and M&A. Right? So private equity advisors, hedge funds, venture capital firms that are sponsoring SPACs are all seen as kind of the top tier because they have the back office service behind them. They have the experience of going through these deals. What insurers just make sure isn't going to happen is that lazy or limited diligence is being done. Something gets through, a short seller catches onto it, that results in a securities claim. So the experience of both the management team and the sponsor are incredibly important. Beyond that, it's the target industry, and then sometimes more importantly, the geography of where you're searching for those targets. So sectors such as cannabis, EV, pre-revenue tech, we've seen some related to space technology, right? Those sectors are treated much differently, right? Because there have been issues in the past. Those tend to drive from a sector perspective, the majority of securities class action claims broadly outside the context of SPACs, biotechnology and pharma as well. So target industry is incredibly important. Where you are searching for those targets is also important. And so underwriters look for teams that are searching for US targets. They have more confidence in the diligence that's going to be done there and the representations that are being made Some SPACs may focus on Southeast Asia or South America or developing economies. That's more challenging for the insurance communities. And so there's a premium to be paid for SPACs that are focusing on those targets as well. That somewhat rounds it out on the D&O insurance front. So if anybody has any questions there, please let me know. We'll give it a second, then John, I'll pass it off to you. We can talk about how reps and warranties can be used to protect the transaction as well. Just give it a second here. Okay, John, you're up. You're on mute.
Let's unmute. Thanks, Andrew. And I think we've already started getting into, some of the questions have been pretty broad around transaction structures, and it's right that most SPACs are done as a reverse merger, reverse triangular merger under Delaware law is pretty standard. And I want to talk a little bit about beyond D&O and the most important thing, the most important message we can probably leave you with coming out of this is that as a SPAC sponsor, as a PIPE investor, you want to make sure that the business that the management's going to be protected with a D&O policy that's really broad and goes for the full 24-month term of the search period, and then in particular when you have the combined company, that you put a good public company D&O policy in place as well. I think that's all really critical for protecting management, for protecting the D's and O's of both the SPAC, the target company, and then the combined company post D-SPAC merger. I think something that has been largely overlooked as the SPAC world has come alive, as everybody knows, over the last year or so, but it existed even before that, was beyond the sort of traditional D&O insurance that's used to protect directors and officers and entities on merger situations, as well as just for the life of those entities, is what about the reps and warranties that are given on one of these D-SPAC mergers? And I think that there's an enormous amount of liability that goes, I would say, above and beyond what's going to be captured in a D&O policy. So I want to, and a lot of you have worked with rep and warranty insurance. I don't want to make this a primer on the product. I do want to just think a little bit about in the context of a SPAC transaction, or really a D-SPAC merger transaction, how it's something that I'm always surprised that advisors aren't doing a better job. And by advisors, I mean law firms and investment banks and other advisors aren't really thinking about should we be looking at getting rep and warranty insurance put on a D-SPAC merger transaction. And so just to think a little bit about the basics and how they play into that. So when we look at the sort of chart on the left, this is just thinking about where does rep and warranty insurance sit within a transaction. So let's take a typical size of a D-SPAC merger transaction. Total consideration is probably going to be somewhere in the neighborhood, or total enterprise value, TEV, is going to be in the neighborhood of around $1 billion on an average one. And so, if you've got $10 million or 15 or even $20 million of D&O insurance, it's a pretty small number. That's going to help protect directors and officers and pay for their legal bills in the event of there being securities litigation. Is it going to make, there's two issues. One is it going to make the enterprise whole in the event of a breach of a rep or warranty, right? So if there were tax reps that were breached, and it turns out that the target company hadn't been paying its taxes or filing returns, and had sales and use exposure all over the country that wasn't accounted for, or it had misrepresented its financial statements, or it had intellectual property that it didn't actually own, or was infringing or invalid. If there were really significant issues, or there was a material contract that was very significant in the context of that business, then in $1 billion transaction, it's not going to be a 10 or 15 or $20 million problem. It might be a 50 or $100 million problem. And so having, and the average rep and warranty policy that we placed on private company transactions last year was about 16% of enterprise value. So on $1 billion transaction, you probably want to buy, maybe not 16%, but you probably want to buy 7.5 or 10%, so that if you've got a bad material contract or an infringement issue, or unpaid taxes, then you've got substantial limits to deal with that exposure. So thinking about, the amount of insurance available, I think is really important. But the other thing, so that's kind of above it, but it's also the breadth. So a lot of insurance brokers, they don't like to talk about, what is rep and warranty insurance versus D&O insurance, and do I need both, or do they do the same thing? Because most of them don't understand. A lot of rep and warranty insurance people don't understand the D&O world, and vice versa. And that's why Andrew and I wanted to speak to you together, because I think it's really important to understand that, under a D&O policy, number one, you have to allege and be able to demonstrate a wrongful act. That's a tougher standard than just showing that there was a breach of a representation. Representations are effectively contractual issues, and to show a breach of contract because you've made a misrepresentation, and this happens all the time, right? It happens. I'm going to show you a slide in a minute. 1 out of every 4 or 5 transactions that are insured has a breach of representation. So it's a very common thing. And candidly, if you're giving 40 pages of representations and going through a disclosure process under enormous timing pressure and financial, stuff happens. It's easy to get stuff wrong or to miss things, and either to omit something or to misrepresent something that ends up being a breach of a representation. So, when you've got 40 pages of representations, the chance of there being a breach is both more likely in a lot of cases than, and the frequency of rep breaches is a lot higher than the frequency of securities claims and class actions. But it's also an easier hurdle to get over, just to demonstrate a breach of contract and the damages that flow from that. So it's both the amount of potential losses, but it's also the breadth of that, and showing a breach of contract versus showing a wrongful act. And then within a D&O policy, they're really designed to indemnify directors and officers for these wrongful acts that either impact the company or impact the Ds and Os themselves. It's very different than saying, we've lost, we thought we paid, $1 billion for a company, or it had a total enterprise value of $1 billion, but because of misrepresentation, it's only worth $850 million. It's a very different measure in terms of loss. And the way that loss is defined and works in a D&O policy is also very different than under a rep and warranty policy. So it's always surprising, I think, for us, when either clients or their advisors say, well, we're not going to, it's a D-SPAC deal, it's effectively a public deal, we don't need insurance. I think really just the opposite. It's one where, the enormous pressure that you're going to face as a public company, really militates towards saying we probably want to be insured. The last thing we need is to find out that there was a misrepresentation that costs us, $25, $50, $100 million in enterprise value because of that. So I think there's all kinds of reasons for it, both in terms of amount and types of losses and ease of demonstrating a claim. So that's the first thing. And then, just thinking about what does it cost, how does it work? So we talk a little bit at the top right about rates online for the product. They've actually gone up a little bit in the last year because of the frequency and the severity of claims that we've seen, but really more around the margins. It remains a very deep market. And obviously there's a retention hurdle to get over. So on smaller deals, it's about 1% of enterprise value. On $1 billion deal, it's going to be more like 0.5% of that enterprise value. The rep and warranty insurers are not interested in the noise of a transaction. They're really interested in catastrophic and material issues that come out and destroy substantial value. The other two charts here, it's really around who pays for it. I think it's, we're really looking at something that's not an ordinary course business expense. It's going to be a capitalized M&A cost, just like your advisors are. It's a one-off expense in connection with it. So there's no magic in terms of who pays for it, but it can be done either way. Insurers are agnostic as to where it comes from, as long as the premium is paid. And then the chart that's kind of in the middle bottom is an interesting one too. And this really goes to, our sellers providing recourse. And this really deals more with private transactions, as data does when you're looking at it. And, when you're looking at a D-SPAC transaction, here's where, and if you can go to the next slide, Andrew, I think you have control still. I think here's where the magic kind of comes in. So a couple of years ago, it was really difficult to get minority deals insured. So most D-SPAC deals, the vast majority of them are minority deals, right? The SPAC is acquiring on average between 30 and 35% of the shares, and the rest of it is basically the target company rolling over in private equity parlance. So we're looking at this gray box on the right. And going back 3 years ago, we couldn't get, even on private company transactions, we couldn't get rep and warranty insurers to insure them. Today we can, and not just to insure the 30 or 35% that's being acquired, but to insure on a 100% company level loss basis, provided the seller gives a statement saying that they're not aware of a breach at the time that the transaction's entered into. So that's really powerful, where you can use insurance to insure not just that minority interest that's being purchased, which is great. And many insurers will offer that. We now have a few markets. So just as with the SPAC market, it's not 25 or 30 that can write a lot of other kinds of D&O insurance. It's really 3 or 4 that will provide 100% coverage subject to that NCD. As with the SPAC transaction, the D-SPAC merger rep and warranty coverage is going to be dependent on industry as well. So things like cannabis that are seen as more difficult, areas of healthcare, including life sciences and pharma, more difficult. Certain financial institutions can be more difficult. But there is broad appetite, across the market and across industries and across deal size. And, I think the really important things are, and I would say, introduce the concept of using insurance before you get to definitive documents, because most de-SPAC transactions, you're really looking at a public company style of agreement, of merger agreement, and the reps and warranties, where there's going to be a lot of qualification by materiality in particular. And so, and even MAE qualification. So getting insurers to sort of disregard that or scrape that up, it can become more difficult. If you can make it look more like a private company merger agreement, it's generally going to be easier to insure the reps and warranties in that case. And I think the most important point is, you have to treat this minority, and most of the time this is the case, but you have to treat that 30 or 35% minority, effective minority investment like it's a majority investment, like it's a control investment where you're doing full scope financial, tax, legal, if applicable, environmental and technical diligence on the target company. So you really do have to have full scope, deep, thoughtful and well-advised diligence process in order to get this insurance in place. So I think it's a great news story. So, we can ensure these, the representations that sellers are giving on a company-wide basis, so that if you've got something that goes missing, it's not just going to be a 30 or 35% allocation of loss that gets paid to the SPAC sponsor, although that's also available, but we can actually do it on 100%, of company-wide loss or shareholder basis as well. And then, Andrew, if you can just flip to the final slide, and then we can go to questions. This goes to the point I was talking about around frequency. And I think this is AIG's data from their claims study last year, but it's very similar to the other big insurers' data. When you look at frequency this is frequency of claims against all rep and warranty policies written over the past few years by AIG, the highest frequency they have are actually in the band size of bands, the deal size range. So think about that as TEV between 500 million and over $1 billion. 500 million and up, is really where we see the highest frequency of claims. And so, again, 1 in 4, 1 in 5 of all of these have claims on them. So a pretty good reason to think about, do I want to insure this transaction? Or, as a SPAC investor, do I want to take the risk on that, there's been, sufficient enough disclosure and everything else that I'm going to be protected. So I think it's one, given the cost of this insurance is really a rounding error. I mean, the average cost of doing a SPAC IPO is going to be somewhere between 6 and 10 or 11 or 12% of total proceeds. So the cost for doing it is high. The cost of buying insurance is going to be more like 0.2 or 0.3% of the size of the deal. So relatively low cost to give protection around these issues. So I'll stop there. I'll pause, and again, we really hope you have some questions. We love to talk about and get into depth on stuff that either doesn't make sense, or you have questions about it, or you'd like to know more. Can I put a general question out there? And I'm curious, is anyone working on a SPAC right now? Anyone have opportunities in the pipeline, either as sponsors or pipe investors or otherwise? Something that people have kind of on their desk right now? Well, we'd love, and I'll turn it back to Andrew and Adam, but we would really look forward to working with you and advising on all of these de-risking aspects, either from when you're first looking at doing your listing and doing the D&O insurance up through the completion of the de-SPAC merger.
Yeah, I'd echo John's comments. Appreciate everybody's time. I was hoping it was educational for everyone. That was really the intent of today's purpose, right? As you mentioned, right, the D&O insurance marketplace for SPAC D&O is incredibly challenging right now. We do have some pretty unique strategies and some new products that we put out there recently that saves 20 to 40% for your clients without having to sacrifice coverage. So to the extent you have any questions after today's call, I think we'll share the slides to the extent that you need them. Happy to walk through any of that information with you.
Hey, Andrew and John, before I let you go, I'm actually working on 2 SPAC transactions right now where we're representing at Outcome Capital a private company that is being bought by a larger company that is immediately contemplating, moving into a SPAC process. One of them we're a principal in, and I'm on the board of directors, so I'm sort of interested in your risk thoughts personally, and that's in one of our venture capital funds. The other, we're acting as an agent, and neither is in the EV space or the high risk areas. These are both software companies, and in one case, and they're both of the companies that are acquiring our private company are larger companies and well backed by private equity groups. We've got D&O insurance. One's further along than the other. We've got D&O insurance and we've got rep and warranty insurance in the one that's going to close this week. Is there, as a director of that first company, should I be looking for anything out of the ordinary that I wouldn't look for in those 2 insurance policies? Again, we don't know when that company is going to find a SPAC and when that transaction will occur, or if it'll occur. We're only being told that that is the process they're going to immediately embark in after they finish the acquisition with us.
Sure. Yeah. So there's a few considerations, right? Whenever you have a company that's going through a SPAC transaction. So oftentimes what we find is that the limit adequacy of the companies that are going through SPAC transactions is not up to par with encompassing securities exposure, right? In the context of a private company, right, there's not many severe claims you could see outside of a bankruptcy, right? And so many private companies will buy considerably lower limits than their public company peers, right? If a public company buys 50 million with similar revenues, private company maybe buys 5 million, okay? When you add in that potential securities exposure, because you're going to be making representations to a SPAC, you need to think about how do we adjust our program to encapsulate that new exposure, that new risk. In addition to that, the policy at a private company, like we mentioned before, may exclude securities litigation in some aspect, right? Most of those exclusions are tied to traditional IPOs, but the way these insurers think and operate, they'll try to use that if they catch a significant securities claim, even if it's not related to an IPO, if it's just related to the SPAC offer. So limit adequacy is number 1. Number 2 is making sure that policy is crafted properly and that the language isn't going to prohibit coverage for a securities claim for either the individuals or for the company itself. And so oftentimes we'll get engaged in that process pretty early on with target companies. If they're just exploring a SPAC, to take a look at their program to make sure that language is lined up properly, or if we identify any gaps or red flags, we fix it well ahead of that transaction.
Yeah, I know the limits are at the full limits of the transaction. The rep and warranty is 100% of the stated, except for fundamental liability, it's 100% of the rep and warranty limit, subject to the deductible, which is very manageable and escrowed. But I have to say I haven't looked at, what the recitals are. Should that insurance policy have to come to the defense of the former directors as a public vehicle? Yeah.
Yeah. Look, I think it's really prudent that you've got, I think, beyond putting rep and warranty on that pre-DSPAC acquisition, I think that's, prudent. I would always say that, right? Because you look at the frequency and the increased severity of losses. But in particular, I think, knowing that there could be an acquisition by a SPAC, in coming months, that's a whole nother set of eyes. So I think it's more of a practical, if you've got a well constructed and diligenced rep and warranty policy in place, that's really the best thing you can do, in addition, as Andrew said, to beefing up the D&O policy in of the actual target company in anticipation of the SPAC. I think that, the reality is it's more practical. You're going to have a whole nother multiple sets of eyes on that prior transaction you've done and looking at it, for valuation and, did you go through a good process and governance and everything else. So I think you're doing the right thing, which is what you should do. I just think it takes on added importance. And so having, robust limits and a good process and everything, it seems to be prudent. I'm not sure there's anything you can do to go beyond that.
Thanks.
Welcome. Anyone else? Timing. So Robert Sherry asked, if there are a series of acquisitions leading to a SPAC, when do you need to have a policy in place? So, most private companies will have a policy in place throughout their life cycle. You should, right? So recommendation as far as timing, if you're a target of a SPAC, you should have D&O insurance in place prior to considering a SPAC transaction, because you still have exposures outside being acquired by a SPAC. When you think about timing as how the transaction works and what needs to be done mechanically, right, from a D&O perspective, the target company will have a D&O policy in place prior to the transaction. The SPAC will have its own D&O policy in place prior to the transaction. At the time that the de-SPAC occurs, two things are going to be recommended to happen. One is we'll recommend that both the SPAC and the target company put their policies into what is known as runoff. Okay. Runoff is essentially an extended reporting period, okay, for a term of 6 years for claims that come in after the de-SPAC, but allegedly you did something wrong during the time that you were either the private target company or the SPAC itself. The reason that's so important is you're effectively walling off all those liabilities, all the representations you're making prior to the consummation of the deal into those runoff policies. And then you place a new go forward D&O policy, okay, for the combined company. And that covers all the exposures going forward, so that everything is housed within its own separate program, so that, for example, if there's an issue with the SPAC prior to the business combination or the target company prior to the business combination, that claim isn't going to erode the limits for the go forward directors and officers that had nothing to do with that action, right? So we wall everything off. John, if you have any comments as far as timing on reps and warranties in the context of a SPAC transaction?
Yeah, just really echoing what I said a second ago, which is, as you do that series of transactions, obviously very prudent to have, the broadest possible, reasonable limits and the broadest possible rep and warranty insurance you can get in place. But, clearly having, when someone digs into those previous transactions and finds problems, having policies in place, and they run 3 to 6 years, in terms of the policy term as a source of recourse, it's going to prevent a lot of pain, over recourse coming, above and beyond, again, a D&O policy out of the company itself.